The sixth learning objective is to use the current and debt ratios to evaluate a company. Accounting is designed to provide information that business owners, managers, and lenders then use to make decisions. A bank considering lending money to a business must predict whether the business can repay the loan. To measure the business's financial position, decision makers use financial ratios that they compute from the company's financial statements. Two of the most widely used decision aids in business are the current ratio and the debt ratio. The current ratio measures liquidity within 1 year by comparing current assets to current liabilities. The debt ratio measures the ability to pay liabilities in the long term by comparing all liabilities to all assets. The different ratios give different views of a company's financial health. The current ratio is computed as current assets divided by current liabilities. A company prefers to have a high current ratio because that means it has plenty of current assets to pay its current liabilities. A current ratio that has increased from the prior period indicates improvement in a company's ability to pay its current debts. The rule of thumb states that a strong current ratio is 1.5, which indicates that the company has $1.50 of current assets for every $1 in current liabilities. A current ratio of 1.0 is considered low and somewhat risky. The debt ratio is computed as total liabilities divided by total assets. The debt ratio indicates the proportion of a company's assets that are financed with debt. A low debt ratio is safer than a high debt ratio. Why? Because a company with low liabilities usually has low required payments and is less likely to get into financial difficulty. The rule of thumb for the debt ratio is that below 60% is considered safe for most businesses, as it indicates that the company owes only 60 cents for every dollar in total assets. A debt ratio above 0.80 or 80% borders on high risk. Short exercise 4-11 focuses on the current ratio and the debt ratio. Total current assets divided by total current liabilities. Total current assets equal $12,000 and total current liabilities equal $6,700. The current ratio is 1.79. The debt ratio, total liabilities divided by total assets. Total liabilities are $14,500 and total assets are $27,000. The debt ratio is 0.54% or 54%. This company has 1.79 or $1.79 of current assets for every dollar in current liabilities that it owes. A quick summary reveals that the worksheet is a tool that puts the whole accounting process in one place. Remember that debits equal credits in the first three columns. Columns 4 and 5, which are the income statement and balance sheet, debits do not equal credits until you post the net income or net loss for the period. The formal financial statements yield the same net income or loss that is shown on the worksheet. Closing the accounts is just like starting a new baseball game. The score is 0-0. All temporary accounts are 0 after closing. The post-closing trial balance contains the same accounts that balance sheet contains: assets, liabilities, common stock, and retained earnings. Classification means dividing assets and liabilities between those that will last less than the year, which are current, and those that will last longer than a year, which are long-term. The classified balance sheet still represents the accounting equation and must balance, which is assets equal liabilities plus equity. The current ratio measures liquidity within 1 year, comparing current assets to current liabilities. The debt ratio measures the ability to pay liabilities in the long term by comparing all liabilities to all assets. The different ratios give different views of a company's financial health. If you still have questions, please contact me. I'd be glad to talk with you.